As an investor, we're all chasing that next big win. But what if I told you the secret to boosting your returns wasn't just in your gains, but actually hidden in your losses? Today, we're going to break down a really common tax mistake that could be quietly costing you thousands of dollars year after year. And really, it all boils down to this one question. See, the problem isn't some super complex trading algorithm or a secret stock tip. Nope. It's a simple habit, a mindset that honestly, a lot of us fall into without ever realizing just how much it's costing us. And believe me, that cost can be huge. This one simple oversight can cost an investor $3,000 or even more every single year. That's money that should be working for you, compounding in your portfolio, not just handed over to the government.
Okay, so what is this costly mistake we're talking about? Well, it's not about picking the wrong stock or selling at the wrong time. It's all about when you decide to think about your taxes. Let's call it the once-a-year trap.
And this right here is the heart of the problem. If you only start thinking about your investment taxes when April rolls around, well, you've already missed a boat. You've missed a whole year of opportunities, and the window to make smart strategic moves for the last tax year has slammed shut. It really just comes down to two different mindsets. On one hand, you've got the reactive investor. For them, taxes are just this dreaded chore they have to deal with in the spring. They scramble, gather their documents, and just hope for the best. But then you have the proactive investor. They see the tax code as a playbook, a set of rules they can actually use to their advantage all year long. All right, so how do you make that switch? How do you become that proactive investor? Well, the key strategy is something called tax loss harvesting. And let me tell you, it's an incredibly powerful way to turn a negative in your portfolio into a real financial positive.
Now I know, it might sound a little complicated, but the idea behind it is actually beautiful in its simplicity. Basically, when you have an investment that's lost value, something that's in the red, you can sell it. By selling it, you realize that loss. You make it official for tax purposes. And suddenly, that loss becomes this super valuable asset for cutting your tax bill.
So let's just break it down. It's really just 3 simple steps. First, you look through your portfolio and you identify an investment that's a loser. Second, you sell it to lock in that loss. And third, and this is where the magic happens, you use that loss to cancel out the taxes you would have owed on your winning investments. It's a brilliant move. But, and this is a big but, there's a catch. There is a ticking clock on this strategy. Just knowing what tax loss harvesting isn't enough. You have to know when to do it. And this is not something you can just put off until later. And the power you get from this is just incredible. Your losses don't just wipe out capital gains taxes. If your losses are actually bigger than your gains, you can use up to $3,000 of them to directly lower your regular taxable income. And hey, if you have an even bigger loss, no problem. You can carry the rest forward to use in future years. That benefit doesn't just disappear. So why the rush? What's the big deal about timing? It's simple, really. Markets don't stay down forever. The opportunity to harvest a loss only exists while an investment is actually down. If you wait too long, if you drag your feet, the market could bounce back, and poof, that potential tax break could vanish completely. And that really brings the question right back to you, doesn't it? A down market or even just a temporary dip in one of your investments isn't just bad news. For a smart, proactive investor, that's a signal. It's a flashing light saying, hey, here's an opportunity to improve your tax situation. The question is, are you watching for those moments? Okay, let's wrap this all up with the single most important takeaway here. This isn't about some secret formula. It's about a fundamental, total shift in how you see your finances. It's about switching from playing defense to playing offense. And this is it. This is the key. You've got to stop thinking of taxes as this thing that just happens to you every year. Instead, start seeing the tax code as a rulebook, as a tool you can use, just like tax loss harvesting, to actively manage your outcome and actually improve your overall returns. And in the end, that's what this all comes down to. This one simple question. Are you going to treat taxes like a chore, or are you going to use them as a tool? Is tax season going to be that stressful scramble every spring, or will tax strategy be a powerful part of your investor toolkit all year long? The choice, and that potential $3,000 a year, well, that's up to you.